Well, good afternoon. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland's UM Ventures. And I would like to extend a warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series, both live webinar audience and those watching a recorded version on our Startup PMD YouTube channel. This workshop series is offered by UM Ventures with collaboration from MTech at the Clark School of Engineering and the England Center for Entrepreneurship at the Smith School of Business at the University of Maryland. Everyone attending the live session, please feel free to submit questions using the Q&A function, usually found at the bottom of your screen. We are recording this session. It will be posted on our Startup PMD YouTube channel. So please submit your questions anonymously if you would like to. There's a button that you can click and say submit anonymously. So today's session, we're joined by Mike Ravenscroft. Mike is a venture capitalist and investor who has been investing in university startups and other startups. And he will talk to us about the relationship between the investor and the startup and how to maintain it, just sort of out of his own experience. I asked Mike to think about what are your pet peeves? Can you tell us what to do, what not to do? So thank you, Mike, and I appreciate you taking time with us.
Of course. No, happy to do it. Thanks, everybody, for joining. It's very nice to meet you, and I apologize for having to reschedule this session at the last minute. I appreciate everybody's flexibility for joining on this new time. So I'm going to share my screen here. Can everybody see that okay? Ala, can you see that okay?
Yes, perfect.
Awesome. Okay. I've been playing around a lot lately with AI-generated art. This is one of my, I think this was like a successful venture capital fundraise, and this is what it came back with. So good afternoon, everybody. It's very nice to meet you. I feel free, as Ala said, to pose questions as we go. I also sometimes have trouble seeing the questions feature on Zoom, so Ala, feel free to interrupt me if a question comes through in chat. But I'm calling this strategies and tactics for success for a startup fundraise. As Ala said, I'm kind of here to help folks not make some of the mistakes I've seen founders make. Certainly understandable mistakes. It's very hard being a founder. It's very hard raising money. It's one of the most challenging things you can do in business. So the goal of today is just to try to make your lives a little bit easier if you're a founder thinking about raising money or going out for a fundraise. So I'm going to start this with a disclaimer because we're talking about fundraising and finance. The information contained in this presentation is for Q&A, general information purposes only. I, again, assume no responsibility for errors, omissions, etc. Honestly, this is just advice and nothing more than that. So I always like to sort of have just a disclaimer caveat. This is just my perspective. I'm one person. You ask any other investor, they're going to give you a different set of opinions. And a lot of this is just gleaned from personal experience. So in no way is this considered fundraising advice per se. So today, we did our disclaimer. I'm going to talk to you about how to outline a successful fundraising strategy based on, again, my experience, what I've seen founders do well, what I've seen them do and struggle with. So the benefit of some of that experience there and from the learnings of others. We're also going to discuss some tactics and tips for success that I think can, be small changes that can make your life a lot easier and make the process a lot easier if you're out raising money. And I'm also going to talk a little bit about what not to do. As I mentioned at the top, feel free to interrupt me at any point if you have any questions. Also happy to do Q&A at the end. And I'm also happy to share these slides with everybody. I can post them online after this if you'd like to reference them. So just quickly on me. So I've been doing venture capital investing for about 8 years. I've run accelerator programs. I've worked for early stage investment teams. I've worked for state investment vehicles, and I've worked for private venture funds. I have been with the Maryland Momentum Fund for about 2 years. Momentum Fund is the university system's seed stage venture fund. So we invest in companies that come out of the university system, specifically co-founders who are Maryland alums, faculty, students, staff. And when I say Maryland, I mean the entire university system of Maryland, of course, and also technology transfer companies. As you can see in our portfolio, we've got a pretty wide range of companies covering everything from therapeutics to clean tech to health tech to B2B SaaS. So all this is to say, I see a lot of fundraisers, I see a lot of founders going out and raising money, and a lot of the stuff that I'm going to talk to you today is about first-hand experience that I've had working with founders, helping them raise money, and also founders that have pitched me raising money. So I've organized these into a set of rules, principles, guidelines, guiding principles, if you will. The first rule is that you're not raising in a vacuum. So you're raising in a market. You're raising money from private investors, but you're still raising in a market. And there are forces at play that are sort of beyond your immediate business. And so I always counsel founders before starting a raise to get a read on the market. What's going on in the market? Are the markets frothy? Is there a pullback? Is your space very hot? Are investors overinvested in a specific space? And this is sort of the general thing you just want to sort of be aware of when you're going out to raise money. So general market sentiment, which is hard to define, and we'll discuss that in a minute. But average round sizes, general funding climate, and then graduation rates. These are all things that I think are just important to sort of get a general sense of before you do your fundraise, given that every investor that you're going to talk to is looking at a broader market. You know, you're talking to VCs who are looking at between 150 and 350 companies a year, depending on how big the fund is and how many associates or principals they have working for them. So they're seeing lots of companies, which means they have a read on the market. And they're also looking at general market trends that you're probably looking at as well. So everybody's aware of this, so I don't want to go too much into it. Just round sizes are down. We all know that it's a really tough funding climate right now. Generally speaking, seed and Series A investments are down pretty significantly in terms of total dollars being deployed. And then also average round sizes are down too. There was kind of a peak during COVID. Everybody was raising money. There was lots of money to go around. That has since contracted. There's been a pullback. So there's a lot less money to go around. And companies are raising less. And there are also fewer companies getting funded. Now, the thing that I think is very worth considering, especially if you're a seed stage company or a pre-seed company, is something that we call graduation rates. Graduation is how many companies make it from seed to Series A. So they graduate from seed to Series A. Historically, and in 2020, if you were funded in 2020 at a seed, you graduated to a Series A about 75-ish% of the time. So, or excuse me, 23% of the time. 75% failure rate, 23% success rate. So that means if I'm funding, say, 5 companies, about a quarter of them are going to make it to a Series A. So, right, 1 in 4. If you look at the number for vintage 2022, though, 5%. Meaning if you raise the seed round in 2022, you have a 5% chance of raising a Series A. That is a shocking and terrible number. And so the chief among all investors have lots of concerns when they're evaluating a company to invest in at the seed stage. But the principal concern right now is how well a CEO can keep a company capitalized. Knowing that this is sort of where the market's at, that 5% of companies are making it from a seed to a Series A, there's a really big drop-off that any investor can expect. So the question on my mind when I'm talking to any new company is, does a founder understand this? Do they understand how bad the market is? And are they able to keep the company well capitalized? This is always a concern for investors. A CEO's job, basically, for a company is to raise money. Like, that's true from the seed stage all the way through to publicly traded companies. The CEO's job, yes, is to set direction. Yes, it's to be a visionary. Yes, it's to be, at the early stages, a product owner. But ultimately, keeping the company capitalized falls to the CEO, and that is the CEO's primary job. And this is the second rule of fundraising. I always encourage founders, or I guess discourage founders, from seeing fundraising as this thing that I got to do to kind of keep the lights on, but I really want to go back to doing product development or doing work with customers or sales because that's what I actually enjoy. I am firmly of the belief, and I think most investors are, that a CEO's primary responsibility is fundraising, and fundraising is the CEO's primary responsibility. It's also constant. So as soon as the one round closes, the CEO's mind has to be on the next round. What does it look like? How much money do we need to raise? Because ultimately CEOs are not just thinking 6 months down the road, they're thinking 6 years down the road. They're thinking about building a company in the longer term. CEOs can outsource this job. You can't have a chief business officer or a chief financial officer or an advisor going out and raising money for you, especially at the seed stage. Founders need to be talking with CEO founders, need to be talking with investors directly. It is always a red flag to me if a founder has their chief science officer or their chief business officer doing all the fundraising and they're kind of in the back doing work on the product. That tells me that there might be something a bit wrong there. And it's also, like I said, this is never over. So as soon as a round closes, the next one begins in terms of how you're thinking about it, what the positioning is going to be, what the milestones are going to be. And ultimately, everything you're doing is in service of keeping the company capitalized. This is the other thing I tell founders. If you don't want to constantly raise money for your venture, I strongly encourage you to bring in a new CEO or to think about building the company without venture money. Nobody needs to raise venture capital. Lots of companies are funded without VC. The vast majority of companies are funded without venture money. But as soon as you take investor money, you're building a company with the idea of selling it, scaling it, and then selling it in over a period of 5 to 10 years. And because of that, you're always going to be raising money for the venture. Not necessarily always equity, but you're always going to be having to find ways to keep the company capitalized. So this is something I always encourage founders to think about. If you don't want to get on this treadmill, then it is very important to consider what the alternatives are. I know plenty of founders who are founding CEOs to start and then transition into a CTO role because, hey, they don't want to raise money. They'd rather be doing product work. They'd rather be doing sales work. They'd rather be doing anything other than raising money. So just something to consider as you're getting started. So I mentioned that investors are optimizing for founders have the ability to raise money. They're also optimizing increasingly for near-term profitability. This is something you never used to see in venture capital. Companies would always project unprofitability for the first 3, maybe 5 years because they're focusing on growth. Increasingly, investors want to see companies that have the ability to turn profitable. There's obviously exceptions to this. No early stage drug company is going to be profitable in the first maybe 7 or 8 years, if not longer. Hard tech companies, battery companies, those will stay unprofitable because they're pre-product for a very long time. That's expected. Something like software, though, if the ability to get profitable is there, investors are increasingly looking to see that. They're increasingly asking for a model, a financial model that will show your ability to turn profitable because, like I said, money's really tight. The graduation rate's really low. So if you can't raise a Series A, does the company just hit a wall and go out of business? Ideally, no. Ideally, you can turn it profitable. You can find another way to bring in money so that you have options. Whether you raise money or not, you've at least got the ability to survive. So this is something that I'm seeing increasingly. Again, like I said, it's a bit sector dependent, but generally speaking, if it's a B2B SaaS company or anything that involves generating revenue early on after this first round of funding, the ability to get profitable in the near term is something that investors are going to want to understand. And also, investors are optimizing for what they always optimize for, which is clear milestones, a huge market opportunity, a differentiated technology. So this is basically my way of saying it's always been hard. It's now just a bit harder because of all the market headwinds that I was talking about. So I mentioned this already, this idea of a cliff after the seed round. Be aware that every investor you talk to is going to be wondering about that. So how well can the company stay capitalized? Is the CEO capable of that? Does the CEO know that the company is going to have to be capitalized and that it's going to be hard to raise money? There are almost no investors right now that have appetite for, why don't we just try it, like wing and a prayer approaches to fundraising. Fundraising should always be a scientific approach. It should always be programmatic. But there was a period over the last couple of years where there was money everywhere, so you could be a bit more loose, more flexible with it. Those days are over. There's a lot more appetite for founders who are taking a very rigorous, disciplined approach to fundraising. Milestones and proof points, like I said, those have always been important, but they're far more important. And I'll explain a little bit more about how you can kind of like set those and talk about those in a way that's compelling. But it used to be that use of funds could be pretty flexible. It could be, well, we're going to hire for product, we're going to hire for sales, et cetera. Increasingly, investors are asking founders for very detailed milestones as far as like, okay, what are the revenue numbers going to be exactly? What are you projecting headcount to be in 8 months? What does the ramp up look like? Much more diligence on that front. And like I said, I think a lot of that pertains to the funding environment being challenging, the fact that companies really are going to have to deliver if they're going to succeed. And then also, investors are going to want to know exactly what your strategy is for the round, and then exactly what the strategy is, or at least the thinking is, for the next round. So again, this cliff, right? I want to know what the Series A round looks like, or excuse me, the Series Seed round looks like, but I also want insight into how you're thinking about the next round. How are you thinking about the Series A? When does it happen? How much money do you think you'll need? And is that realistic? Do I believe that this company is capable of doing that? So we've talked about how it's kind of a down market, challenging, etc. How can you succeed? So here is my first piece of advice. Talk to investors very early. The best time to talk to an investor is when you're not raising money. It's a much lower pressure situation. It's a bit more collaborative, discovery oriented. Ideally, you're just talking to each other because you're interested in what you're doing. The investor's interested in what you're doing. You're interested in them as a fund. So there's a bit less pressure. My strong suggestion is to do this at least 3 to 6 months before you even need to raise money. So your fundraising cycle potentially is like maybe 8 months to a year, because fundraising cycles right now at seed stage can take anywhere from 4 to 7 months. Series A can take even longer, but that's starting from, okay, I'm doing outreach to investors, I'm starting to do calls, I'm starting to follow-up diligence requests, I'm starting to present to investment committees, going through the full diligence process to close. That process can take 4 to 7 months. The relationship development ideally is happening even before that. You want to have a very robust network of investors before you even start talking to them when you're raising money actively, because you want to have good relationships. You want to have people that you know that are interested in what you're doing, and you want to have something in place so that when you actually kick this off, you can kind of hit the ground running. Warm introductions through your network are absolutely essential. You would be surprised at who you can get to secondary connections with. I'll talk a little bit more about this later, but I find LinkedIn an excellent resource for that. Secondary connections to fund managers, principals, associates, whoever you can get to talk to at a fund. That's going to come through your immediate network of existing investors, your advisors, any angel investors that have invested in you that you've worked with. Also, other entrepreneurs. Other entrepreneurs can be an excellent source of warm introductions to venture funds. But also, you're going to events in your market segments. So maybe that's conferences, maybe that's local meetups around a particular technology base. Maybe this is like an AI meetup or a SaaS meetup or a battery tech meetup. You want to go where there are investors. You want to talk to them, engage with them, like I said, in like a lower pressure way, and make an effort to have that conversation early so that you can identify your funnel. So 20 targets as far as investor targets, that's better than 10, 50 is better than 20, 200 is better than 50. You sort of get my drift. You want a large funnel. And you also want to do your research very well ahead of time. So if you're a battery technology company and you need to raise a seed round, you should know the universe of the possible. It should not be, okay, there are like 10 funds in Maryland and 3 of them might invest in me. No, you need like an entire landscape of all the companies, all the venture funds that would invest in a company like yours. So that's hardware, batteries, seed stage. There are lots of resources you can use to find those. I'm pretty sure Ventures has PitchBook logins, and I'm pretty sure you can get access to PitchBook through other like UMD resources. That's one way to do it. Crunchbase is another. There are lots of funds. There are very few that you can actually get to and get introductions to. So you want to know exactly like all of the possible funds you could go to, and that involves doing a lot of work ahead of time. My strong suggestion is to focus on funds that you think have a really good chance of funding you. If you're a hardware company and you're talking to a software investor, they won't invest in you. Funds have specific requirements that they raise money behind. So if they're raising money from their limited partners and they're saying they're going to invest in software companies, they can't just go invest in a hardware company. And they also probably won't want to. They just don't understand the space. They don't know enough about the market, all those reasons. You really want to target those groups that actually have a track record for investing in companies like yours. Okay, here's a quiz. You ask your head of sales to see the pipeline for the next quarter. And he says, I don't have a pipeline. I'm just going to catch as catch can. People love our product, so it doesn't really matter. Now, the question is, what happens to this sales guy? I sincerely hope you kick him out the door, no questions asked, because fundraising is sales. You should treat it as such. no salesperson doesn't have a pipeline. No salesperson doesn't understand how to qualify their pipeline. Salesperson who's worth their salt. That kind of approach to sales doesn't get you sales. Fundraising, I stole this image online. This is basically the same as a VC funnel. Like a sales funnel is a VC funnel. You're generating awareness by talking to an investor. You're generating interest in what you're doing by talking to that investor and convincing them that what you're doing is interesting. The investor will evaluate you and see, whether this is going to satisfy, their needs for what a good investment looks like. They're going to negotiate your valuation. You're going to close. And then when you need to raise that next round, you're going to renew. It's basically the same thing. And the best way to start a successful sales process is to start with a very large pipeline, very large funnel. It has to be a qualified funnel, but it's almost identical. And ultimately, you're selling yourself, the vision for the company, and your investability. Here's the other thing I would recommend doing: gather data. So it's hard when you're having conversations with people, because conversations can be pretty loose, especially if you meet somebody at like an event. You're just sort of asking them, like, what do you think about the battery space? I don't know. Batteries on my mind today. I keep talking about batteries. I know a lot of battery companies at Maryland. That's why I'm using it as an example. If I know a battery investor, I would ask them, like, what interests you right now in the battery market? Like, what are you interested in? If you're talking about what you're building, ask them directly, like, what's interesting about this to you? What's not? Like, what's challenging to you? If I pitched you right now and I was raising around, like I'm not raising around, but what if I was? What would your objections be? This is a question, I think, that it's very hard for folks to answer this if you put them on the spot, but chances are they know what they would want to see. So if you just ask them, like, what are the milestones we would need to hit? Like, let's say, I raised $5 million. What would you want me to do with that money? I would try to ask these kinds of questions. And then finally, like, if you think they're interested and you're just maybe a little bit early, or, this is like, they are interested and they'd want to talk when you start raising, well, do you mind if I keep you in mind? Like, would you mind if I follow up with a conversation once we kick off the fundraise? If they're interested, they'll say yes. If they're not, they'll say, it's probably not a good fit for us. Well, then that's fine. Like, maybe add them to your investor newsletter, keep them apprised of what you're doing, but they're not a hot prospect because they're clearly not that interested. But this kind of data, like I said, it takes time to gather this data, but it can be extremely helpful, because if you generally know what the objections or pushback or what the interests are of investors, you'll know how to kind of tailor your pitch. You'll know how to talk up the things that are interesting, and you'll know how to avoid the parts that are less interesting. This is not letting the tail wag the dog. This is understanding where investors' heads generally are at, understanding where the general interest in the market is, and then optimizing for that. So, like I said, this information is going to be used to gather a general awareness for you of the market and the state of affairs and how investors are considering similar opportunities. You're going to understand what's appealing, what's challenging. Like I said, markets have cycles. Right now, if you're in AI, things are very hypey. There's a lot of interest. There's also like starting to hit the peak of the hype curve. So like, where is the market? That's kind of a nebulous thing to figure out. The best way, I think, in addition to reading market research, is to talk to people and ask them directly. Understanding the key objections. This is very important. You should know what the biggest objection to sale is. So before you go into a meeting with an investor, if you've had this conversation, these conversations ahead of time, and you've put the work in to like actually understand what the possible objections might be, like I said, you can optimize for those, and you can also anticipate them so that when they ask that question, you can say, I'm glad you asked that question. Here's how we address that particular problem or challenge. Milestones, like I said, this is the critical piece right now for all the reasons I've already mentioned. But with funds raised, how am I going to make use of those funds? That's a very important question to be able to answer effectively. So if you've asked 10 investors what milestones generally they'd be interested in you hitting, you'll be able to account for that. Now, you might not be able to hit all those milestones. That might mean you'd have to recalibrate your raise, rethink how you're going to hit your milestones, what other milestones might be compelling. But then the other thing you're going to do with this data is you're going to prioritize investors in your callback list. So if an investor shows genuine interest, seems to like you, you seem to like them, you feel like you get along well, contact me when you start the fundraise. investors do like to be first on the callback list. So prioritize those investors that show the most interest, that will be the best fit for the raise, and that when the time is right, will be certainly willing to take the call when you reach out. Okay, how do you know that the milestones that you're setting are the right ones? So a milestone is something you hit in the future, right? So seed stage company, I'm going to do A, B, and C in the next 12 to 18 months. Okay, in 12 to 18 months, I run out of runway. I'm going to need to raise more money. How do I know that those milestones in 12 to 18 months are going to satisfy the requirements that the next round of funding are going to bring? What you need to do is get downstream data. Now, this is always changing because in 12 to 18 months, the world might be a very different place. But ideally, at the seed stage, you're getting a sense for what a Series A stage company looks like, because you're reverse engineering from what success looks like. And the success is raising the next round. So ideally, you're speaking with later stage investors, one, to start cultivating the relationship. Because like I said, these can take months, if not years. Like companies, Series A funds do like to track companies from the seed stage, especially if it's in a small market where there are not that many companies. Like batteries relative to like software, like there aren't that many battery companies relative to software companies. They like to know which companies are in the mix, what's going on, what's interesting. So if you can talk to any later stage investors and ask them, what would you need to fund a company like mine? Is it this much in runway? Is it this much in revenue? Is it this much in partnerships with large corporates? Is it this many users? If you use that to inform the milestones you're setting for your Series Seed investors, it shows your seed stage investors that you've thought through the sort of like longitudinal game that you're playing. And it'll make your life easier because you'll be like a lot more confident going into that Series A raise that the milestones are the ones that you need to set. And this is a reminder, as I said at the top, the market has changed considerably in the last 3 years, really the last 4 years.
I'm not sure I understand.
Sorry. So whatever proof points, milestones, data you think are going to be necessary, best to over deliver. Try to outperform, set aggressive milestones, but try to be even more aggressive in hitting them, because you never know when the goalposts are going to move. A lot of companies that thought they had really robust milestones at the seed stage, 12 months later the market's a lot tougher. They need to outperform, which means you have to raise a bridge round. You have to do more with less, and generally speaking, if the market turns on you, there's a lot more you're going to have to prove to be able to show that this is something that is worthy of everybody's attention. So you've started talking to VCs before you're raising. You've got a large funnel of potential investors. It's qualified. You're tracking all this in a well-organized spreadsheet or CRM. And you're gathering data from those conversations to inform your tactics once the fundraise kicks off. So you're doing all that. Now, when you kick off a fundraise, I always like to ask this rhetorical question. Which of these two guys do you want to be? Nobody jumps out of a plane without a parachute and somebody's got their back. At least I wouldn't jump out of a plane without a parachute and somebody's got my back. So before you start a fundraise, brief your board, brief your advisors, and all your existing investors. You would be surprised. I've had companies come to me saying, we're closing our round in 2 weeks. What round? I had no idea you were raising money. Maybe that just means that my companies don't like me that much. They don't want to keep me informed. I assure you, though, it's more common than not to be blindsided by a fundraise that you didn't know anything about. That's bad, because if that fundraise went poorly, that company's going to be coming to me for a bridge, and I'm going to have no idea that they needed a bridge. I'm going to be briefed, updated, etc. Start the process properly. Get everybody involved with the company on board. Talk about the fundraising plan, but more importantly, develop that with the people that matter. So go to your board. Talk about the milestones you're hoping to hit. Talk about the kind of money you need to raise. Talk about what kinds of funds you're going to want to target. All of the people involved with the company, it's a village, right? You can't do this by yourself. You shouldn't do it by yourself. You have advisors because they're there to advise. You have investors because they have a vested interest and they're going to want to help you. So discuss this plan with everybody that matters relative to the company. And then also talk about potential plans for a bridge. So this is pertinent if you have existing investors, like angels or even a seed fund or two. it is very important to understand what the parachute looks like. Let's say the fundraise takes longer than anticipated. Let's say we might need more milestones that we haven't hit yet. We need to cut burn and extend runway. We need a bridge. Talk about the bridge plan well in advance. It looks far better, it reflects far better on you than if you start raising money, you don't really brief anybody, you don't have a bridge plan, it doesn't go well, we got 2 months of runway, we need a bridge. You don't have much negotiating leverage in that position, but also it just makes everybody feel bad. If you get all this done in advance and you go out to market and guess what, it's harder than you thought, the funds just aren't biting, then everybody's going to be a lot more amenable to the bridge because, hey, you talked about it. You knew this was a possibility. It's a down market. Things are hard. We're going to have to reassess. But that way, everybody's on the same page. Everybody's on board, as opposed to you're doing all this yourself. And then if you have to go for an emergency bridge, you're kind of like basically begging for money at the last minute. Nobody wants to be in that position. I would also build financial models around this. If it takes longer than anticipated, model what the ripcord looks like. What does it look like if we cut burn? What does it mean if we pull back our spend on consultants? How do we push out milestones effectively? I say this because the market is bad. It's really bad. And it's going to stay bad for probably the next however long Jerome Powell keeps rates high. So be aware that this is something you very well may have to do and plan accordingly. It's better to plan and not have to use it. What is it? Eisenhower, right? Your plans mean nothing. Planning is everything. Glad I was able to get an Eisenhower quote in. All right. So on the fundraising plan, what is in your fundraising plan? So you got your outreach strategy, which is everything we've talked about already. Investors you're going to target, how you're going to target them, when you're going to target them. The timeline, again, I would anticipate at minimum your raise will take 3 months. More likely, the median is around 6 months. If it's a seed, if it's a Series A, it could be 7 to 8 months, maybe longer. And that's like start to finish. So be aware that the first conversation with an investor, that could then take 3 or 4 months to get to a term sheet and then close. So timeline is very important. Understanding what that is, understanding your runway, and again, whether you might need a bridge. Amount that you need to raise. That's not a number that's pulled out of thin air. It's also not a range. So don't raise between 1 and 5 million. That's a huge range. The amount you can do with 5 million is hopefully a lot more than what you can do with 1 million. Pick a number based on the milestones you need to hit, reverse engineer it from what you think those milestones need to be in order for the next round to be raised, and have that be a very clear use of funds. So if you're projecting 10 enterprise accounts by the next 18 months, you're going to have 3 dedicated sales reps, you're going to have 1 sales engineer, you're going to have 1 customer support. Whatever those numbers look like, very clear use of funds. It makes your raise a lot more compelling, and it tells me as an investor that you've actually thought through everything and that you've planned accordingly. What's not in the fundraising plan is valuation. So I've seen boards set a valuation. I've seen boards say, we think the company's worth $15 million, so we're going to set the valuation to 15, and that's the term sheet that we're going to go after, and that's what we're going to raise at. Investors will ask you what your valuation is. They'll ask, what valuation are you raising at? Like, this is before you have a term sheet, before you have any actual investment offered by an investor. What's your valuation? There is only one correct answer to this question, and that is that the market will determine our valuation. So just like in sales, don't make the first offer. If a company says, what are your aspirations? If the venture fund says, what are your aspirations around a valuation? We don't have terms yet. We're raising $3 million. We don't have terms. Get comfortable with that silence. Investors always want you to give the first number so that they can counteract it and lowball it. If you get pressed and they say, you must have some idea what your valuation is, like, come on. Like, if you want to give an answer beyond what I just said, the market will determine our valuation. You can say, well, we're raising a seed round of $2 million. And, the seed stage founders are typically diluted 20 to 25%. So we assume the valuation will be commensurate with the market. That's as specific as I would get. You don't have to get any more specific than that. You want them to give the first offer. You want them to give the terms. The worst thing you can do when you're talking about valuation is to float a really high number. because investors are increasingly looking at valuation as sort of like a founder's ability to read the market. And if you say, well, we think the company's worth 25 million bucks, you don't even have a product yet, it's going to make you look like you're sort of pie in the sky. And sometimes investors won't even make an offer because they'll think that you won't accept it. If they're in the range of like 6 to 8, and you have to come down from 25, that makes it very hard. Now, you may not like a $6 to $8 million valuation, but that's why you talk to more than one investor and why you get multiple offers. It's the only way to generate fear of missing out is to have competing term sheets. All right, we're to the back half of the innings here. 6th rule. Have your data room ready before the fundraise starts. Everybody should have a data room. Even if you're not raising money, you should have all your corporate documents in one place. This is the standard repository for any documentation related to a capital raise. All information that's relevant in any way to company business and operations. Don't do this after you get asked for a data room. Do it well before. It's something that's not static. You're adding to it all the time. If you get a new contract, a new customer, that new contract goes into the data room. If you make a new hire, that person's resume goes into the data room. If somebody leaves, you pull their resume from the data room, you pull their name from the company org chart. You're always updating this. And that's because an investor asks for it and it's stale or it doesn't have the right information. It's going to make you look like you're ill-prepared. And again, that just reflects on your leadership. If you ask yourself the question, there's no way an investor is going to ask for that. Like, there's no way they want this in diligence, is there? The answer is always yes. So more than you think is necessary. You want to be very organized. You want folders. You want clearly labeled. You want to be able to point to file paths. If an investor says, where's the cap table? Here it is. Here's the link. Here's the file path. You also want to create a diligence spreadsheet. So this is basically like a table of contents. So you can send this to me ahead of time and say, like, hey, Mr. Investor, here's all the corporate information. Here's the file paths. Here's where everything's organized. Let me know if you can't find anything. Also, use an encrypted privileged access folder, Dropbox, SharePoint, Box. You want to know when investors are going into the data room. So you want something where you can sort of like get an audit log. It's just helpful for you, helpful to know what they're looking at, helpful to know who's in there. Try not to email documents, especially not anything with PII or company sensitive information. Just don't do it. Use a secure file share. It's worth the investment. Practice your pitch until you can have your deck crash. I have seen this. And for founders who rely on the deck and they can't present without it, it's really uncomfortable. It's unfortunate, right? Nobody wants a deck to crash, and ideally it doesn't happen to you, but it can happen. But I've also seen founders have their deck crash, and I've said, we'll just talk. Let's just talk through what this is. And if they can nail that, it is extremely impressive. So it's actually a way to stand out is to have your deck crash and be able to run your pitch. You don't want to sound scripted, but you do want this rehearsed well enough so that you don't need the deck. Like, you need to be able to take me through the problem, through the solution, through how it works, what the market opportunity is, the vision, the competition. The best way to do that is to practice. So nobody, walks onto a baseball field and, just is immediately a great pitcher. You're always practicing. Definitely get feedback. How it sounds to you, it's going to sound a lot different to somebody else. And I would strongly suggest getting people who are gonna actually sandblast the thing, give you real meaningful feedback. Don't just get your friends and family to give you nice feedback. You want this to be tough. You want to know what the weakest part of the story is before you pitch an investor. You want that to happen in a safe place. And you want everything to be clear, everything to make sense. And you also want to practice being interrupted. No VC lets you get through a presentation uninterrupted. So have people practice asking questions and you answering questions on the fly. Again, hundreds of times. You really want to know this inside and out, start to finish, and no part of this should be challenging for you to remember without your pitch deck. This is kind of obvious, and it's also a gross oversimplification, but always make sure with your presentation, story makes sense, clear business model, compelling vision. Think of an answer to every possible question. So There's an old saying in law: lawyers don't ask questions to which they don't already know the answer. Entrepreneurs should not be surprised by any question they get from investors. So you should have practiced this enough and gotten people to, again, sandblast this enough that you're not surprised when people ask tough questions. You should also ask like outlier questions, like questions that you don't expect. Like really try to figure out all the possible ways people could poke holes in your story, because that's what VCs are going to do. And it's better for you to be very well practiced. It doesn't mean that you have the best answer to everything. I mean, there might be a problem that you haven't resolved, but it's okay. Like every company has problems they haven't resolved. What's important is that you have an ability to account for it. And it's like, yes, you're right. That is a challenge. We don't have the data that you're talking about. That data is going to come in the next 12 months. We just don't have it yet. We're too early. What are the questions you would ask if you were pitching somebody, right? It's like really try to put yourself in the audience's seat here, and practice your answers. So one of the worst things you can do is ramble, either in your presentation or in a Q&A session. Practice getting your answers down to very concise, like 30 to 60 seconds or less. Make sure you're answering the question that's asked. You'd be surprised how many people answer the wrong question. One of the tricks I use for that is restating the question back. So it sounds like what you're asking me is this. Half the time they'll say, that's right. You'll be like, okay. That gives you a chance to actually think of your answer as you're restating the question. It also makes absolutely sure that you're answering the right question. And half the time, somebody might say, actually, no, what I'm really asking you is this. So that's very important. If you're in a group setting where there's more than one person, like the CEO and say the CTO and the chief medical officer or chief science officer, the CEO is flight control. The CEO is the one who is answering every question. And if he or she does not want to answer the question, or it's like, you know what, that's a great question for our technical team, put it over to Jerry, chief technology officer. Jerry, can you take that one? Right? The CEO is flight control. Nobody answers a question before the CEO unless it's directly directed at that person by the investor. One question gets one answer. If you have a group, I've seen this happen a lot. If you have 3 people on the call, the CEO will answer the question. The investor will say, oh, okay, got it. And then the CTO will jump in and say, can I just add to that? The answer is no, you should not add to it. If the question is answered, the question is answered. It is very important that you don't waste time in these conversations. You don't have unlimited time with an investor. You have very limited time. You want to answer questions concisely, clearly, and you want to move on because there are going to be more questions. If the CEO is not in control of the conversation, if other people are kind of chiming in, one of the worst things you can do as founders or as team members is cut each other off or answer the question a different way or correct somebody on a question. Don't do that. It sows discord. It makes it look like you're disorganized. It makes it look like you're competing for airtime. The CEO is the one who is running the conversation, and the CEO is managing how questions are answered. You can always follow up. You can always do a deeper dive at a later point. But ideally, especially if this is like a first or a second call, you're trying to cover a lot of ground. So you want to be truthful in your answers, but you want to be clear and concise. And you want to get to everything that the investor wants to get to. Sorry if it seems like I'm spending a lot of time on questions, but this is so important. And nailing the Q&A, like your pitch could be great, but if you flub the Q&A, it's going to raise serious questions. So really rehearse this, practice this, and get yourself and your team comfortable with the format for a clear Q&A. Okay, 9th rule. Activate your network, warm introductions. When I was a junior investment associate, I monitored our info at email address. I learned really quickly that that's where pitch decks go to die. Very few info at emails make it to a conversation, like vanishingly few. The same goes for cold LinkedIn outreach. This is one of the things I don't like about venture capital, frankly. It's very hard to get investors to talk to you, even if you're doing something interesting. The truth of it is investors are getting bombarded all the time. I get probably 20 LinkedIn outreaches a week from companies in like Slovenia and Argentina and like California, like all over. People that don't know me, that don't know the fund, that don't know that I can't invest outside of Maryland. And that's just garbage, right? It's spray and pray. So the bias from an investor watching their LinkedIn is going to be that. The bias is going to be that this is a waste of my time. So what you want to do instead is get introductions. Those introductions can come from a number of different places. Existing investors is one. That's obviously a very good source of introductions. I'm constantly connecting my companies with investors, like always. It's one of the biggest value adds that I can bring to my companies. It's also just super important because I know a lot of investors. If I'm not out there like pitching my companies, then who's going to? Advisors too. So ideally, you've brought your advisors on board because they're very well connected. They know the industry. Ideally, they have access to capital. They know investors. So use them. Any other warm contacts, like people you've worked with that are at a venture fund, people who know or are secondary connections with somebody at a venture fund, entrepreneurs who have been funded by a venture fund, those are great connections. I always take a referral by a founder that's one of my portfolio companies, always. I'll never say no to those conversations because I respect my founders. I respect that they know what they're doing. And I value their opinion, and I want them to connect me with other entrepreneurs that they think are doing something interesting. The second degree connections tool on LinkedIn is one of the most valuable assets, one of the most valuable tools in your toolkit. Definitely use that. The best way to do this, though, is not to email all your advisors and investors and say, "Hey, we need introductions." Great, that's a giant ask, right? Like, there are hundreds of venture funds you could possibly get funded by. I also don't know who you're reaching out to, right? Like, even though you might have showed me the spreadsheet, like, I have a full-time job. I'm an advisor, but I have a full-time job. Like, I might not necessarily know to like look through that entire spreadsheet and go through and figure out all the people that I know. The best thing you can do is take the time, go through LinkedIn, and, oh, hey, Mr. Advisor, Mrs. Advisor, as you know, we briefed you, we're raising around. We also think that Acme Venture Fund would be a really good fit. We saw that you're connected with partner at Acme. Do you know that person well enough to be able to make an introduction? If you don't mind, I'm attaching a copy of our pitch deck and an email that you can forward on. Really would appreciate it. Most of your contacts, most of your investors will do like a double opt-in. This is what I do. I think it's industry standard, where I'll get this information from my founder, and I will then email my contact at Venture Fund X, and I will say, hey, I got a founder in my network, actually one of my portfolio companies that's raising around. I think it might be of interest to you. Here's a brief description, and I'm attaching their pitch deck. This is sort of like this is made up, but it's sort of like pulled from a bunch of different companies in my portfolio. But company X does this. It's different and unique because of this. Here's the traction to date, and here's why this is impressive and why we're excited. A little bit about the team and why they're so amazing, and then something about the current fundraise. This is all information. You want to have this in a format that your advisor can just go forward. Like, make it as easy as possible, because people are busy. These requests they come in all the time. They often drop off. So you definitely want to make this easy for your investors, for your advisors, for the other entrepreneurs you want to connect with. Sometimes founders will reach out to me and say, can you connect me with a person at this venture fund? And I will say, I know I'm connected with them on LinkedIn. I don't know them that well. They never return my emails. So it's like, okay, no problem. Moving on. This is the part of the process that takes a lot of time, like going through and figuring out who exactly is connected with who. This seems easy enough, but honestly, I would get an intern to do it. Like, bring on an intern, have them go through your LinkedIn, your advisors, your investors, cross-reference that with the funds that you're targeting. This is a sales process. This is a sales pipeline development. It does take time, but I encourage you to put the time in, because if you can get to this point where you can just forward on an email to a high-value contact and get that introduction, then the job is much, much easier. Okay, I swear I only have like 2 more. If you talk to one investor, you're probably pitching 5. And what I mean by that is investors are always talking to each other about all the kinds of companies they're seeing, specific companies. I do quarterly catch-ups with probably like 25 VCs at this point. Most of those meetings are me pitching my companies and telling them what I'm looking at, what I'm interested in, why I think they might be interested. I'm also trying to get a read on the market. I'm trying to hear what other investors are looking at, especially if they're Maryland based. Like there's a whole lot of like cross collaboration that and companies that I might want to take a look at that I don't know about. So investors are really willing to share their opinions. They do this, one-on-one. And honestly, if an investor passes, you definitely want to leave them with a good impression. Investors pass all the time. We look at upwards of 150 companies a year. I maybe invest in 3 to 5, right? It's a very, very low hit rate. I've also talked to a lot of founders that I've passed on, and they have left me with outstanding impressions. Like we disagree on like the market opportunity. That's fine, right? Like a founder is going to build the company that they're going to build. I'm not going to tell them what company to build. If we have a divergent opinion on something, as long as it's a good interaction and we have a good conversation and we agree to disagree, that's great. I will often refer companies like that to other investors. Like, I don't think this is a good fit for me, and here's why, but it's interesting, and you might want to talk to them. This is the way you use this to your advantage. So the disadvantage is if you make a bad impression, you might have an investor talking to other investors like, oh, didn't find it that interesting, and here's why. That's the downside. The upside potentially is that you get introductions to other investors through this. If you talk to a Series A fund and they think you're too early, they might connect you with some of the seed funds that they've worked with. Again, if they think that what you're doing is interesting, they'll refer it out to their network. And as you get interest from one investor, you can cultivate relationships with other investors that they've co-invested with, so you can kind of do a one-to-many. Like, oh, you're interested in this. Are there any other funds that we should talk to that that are in your network that we might be a good fit for? And my last rule of fundraising, I didn't want to do 11. 11 just felt too like Spinal Tap, so I'm doing 10.5. So the 10.5 rule of fundraising is to gather data continuously and to be prepared to modify your approach if something's not working. Anytime you get a pass, try to understand why. My strong recommendation is that you don't argue, because if an investor says, we don't think this is a good fit for us, it's only going to do yourself harm if you try to counter their points. Like if they say, we don't like the market opportunity. Well, you're wrong. Here's why, right? Like that's just kind of confrontational. And like, frankly, you can't convince anybody of a market opportunity if they don't think there's a market opportunity. If they're like factually wrong about something, if they're like, well, we don't think your revenue's high enough, it needs to be over $1 million. Oh, it actually is over $1 million. Maybe there's a confusion, right? But like, generally speaking, you just want to understand. You want to understand the objections to sale. Again, treat investors like customers. Like you wouldn't tell a customer they're stupid if they decide not to buy their product. But you do want to understand why they're not going to buy. And if you can, chalk this up to they don't understand, which is fine. We're not a fit for their fund. That's also fine. Or there's an issue we need to address in our approach or in our pitch, and that's not fine, right? If there's something wrong with how you're communicating the value proposition, with how you're explaining the market opportunity, with the credibility of the team, that's not fine. That's a problem that needs to be addressed. So the only way to do that is to get feedback. A lot of investors don't give feedback. It's frustrating, and like I understand that that's why founders often feel like they're flying blind, because you're getting no's, but you don't know why. Some funds do, we do. I feel like it's part of our mission. A lot of investors, if you just ask them like, hey, look, you don't need to write this down. Just give me a call. I just want to understand. Like, just a couple words on why you passed. Most investors will give you something. So what's important is working with your other investors, your existing investors, your advisors, your mentors, to try to suss out what it is you can do if trends start to develop so that you can modify your approach. And the other piece of this too, if an investor passes but they're willing to make an introduction, always ask for one, always take one. Like if they're gonna connect you with somebody in their network who might be helpful, I would always take them up on that. even if it doesn't go anywhere, it's important to, take help where it's offered. And this is something that I always encourage founders to ask. Like, if they pass because they don't think you're a good fit, like it's too hardware heavy, there's not enough here that like we're an energy fund, there's not enough that targets energy. Like, okay, is there anybody else you suggest I might talk to? Are there any other funds you think would be a really good fit? Some of the time they won't give you any, and sometimes they might. And like I said, if you make a really good impression, then they might be willing to make an introduction, which can go a long way. So, before your fundraise, there's before, during, and after. So before the fundraise, gather real feedback and relevant data from the market, assess the state of the market, know what you're getting yourself into, and understand what might be in investors' heads before you even talk to them. Build your spreadsheet, gather all the data you can on funds that are active in the space, VCs, corporate VCs, foundations, angel groups. Go through all your contacts and identify any potential warm introductions. Track all of that in a spreadsheet that is a living document. Discuss the raise with everybody in your inner circle. Have a bridge plan in place, and prepare your investors to ask them for introductions. Have your data room built, fully assembled before the fundraise starts. Practice your pitch until you can do it without the deck, and practice answering questions until there's no question that surprises you and no question you can't confidently answer. During the fundraise, get warm introductions however you can, referrals from advisors, entrepreneurs, other investors. Make sure you're keeping tabs on all the data you're gathering. Try to understand why investors are passing, if they're passing. Understand every possible objection to sale and optimize for overcoming those. Don't argue, don't push back, just try to understand. And if you start to see a trend, change tactics. Don't give a number for your valuation. Don't let valuation be the sole guide in your decision. I've seen a lot of companies take a higher valuation term sheet over an investor they preferred. That never works. It is always better to work with people that you trust, people that you like, people that you share the vision for the company, people who will work with you. Valuation is one part of the investment puzzle. I know it seems like the most important part, but if the VC and you don't get along that well, you think it might be a contentious relationship, there's a decent chance they'll try to swap you out for another CEO at the next round. I've seen that happen. Better to work with people that are better for the company. Valuation should not be the sole determinant in that. And we have no time for questions. No, I'm just kidding. I can stay on for a couple minutes if anybody has any questions, but that's all I have. Thank you guys for listening.
Thank you, Mike. This was a really fantastic session. Lots of great information. If anybody has any questions, please feel free to type them in, or you can also raise your digital hand. There's a button at the bottom and I can unmute your mic. But while we're waiting for questions to come in, I have a question.
Go ahead.
So actually a couple. One is, what are some of the questions that you've seen that stumble entrepreneurs?
Yeah, so I think the obvious one, this is not like a specific question, but if a question is asked that is like a 1-word or a 2-word answer, like what was your revenue for 2023? And the answer is sort of long and labored, and it's like, well, we had a number of contracts that renewed, we had a little bit of churn, but and then you sort of going on and on. The answer is a number, right? The answer is, oh, it was $300,000, right? And I can provide more context as to why that number was lower than we wanted it to be, but it's sort of like the stumbling block is like not asking the question that's not answering the question that's answered, especially if it's one that's like super concise, like how many people are on the team? 10 full-time, 2 part-time, right? It's like if the answer is short and it can be short, then make it short. Don't like belabor it.
Yep. Thank you.
Yeah.
Well, we're waiting for more questions. I have another question. How do you handle investors who reach out to entrepreneurs and they're not necessarily, a well-known name investor? How do you do due diligence?
And they're not necessarily what, sorry?
They're not necessarily a well-known VC firm. So how do you do due diligence on investors?
Yeah, how do you diligence investors? Yeah. I mean, so the most direct way is to look at their portfolio, look at the companies they funded, ideally you can have a conversation with a founder that's gotten a check from them and just ask them, like, what do you think? Like, were they supportive? Are they good to work with? Is it problematic? That sometimes that information is hard to get, but it's like the best way to get it. I think the other thing that I would suggest is, if it's a fund that has never made an investment, or it's a group that seems very like sort of mercurial, like a family office, but they're based overseas and you don't know anything about them, you don't know where their money comes from, you know, that's sort of like a reason to want to do further diligence, or sort of a yellow flag. Um, but most funds that are active and that are funding startups, they're going to have some kind of public presence, and like I said, they're going to have funded other companies, so it's more than likely you can get like sort of a conversation going with one of the companies that they funded, and you can sort of see firsthand whether or not the founder enjoyed working with them.
Yep, thank you. Does anybody else have any questions? Yeah, you can either type.
If you want to share my email, I'm happy to follow up online or offline, and answer any questions that anybody has that way.
Yeah,
And I'll share these slides with you so you can circulate them.
Perfect. Well, thank you so much, Mike. This has been a great session, and thank you to everyone who came in and stayed to the end.
Thanks, everybody. Hope this was helpful. Appreciate it. Thanks, Ala.
Thanks. Bye.
Bye.